Welcome everyone to our webinar for Planned Giving and Development Professionals. It's wonderful to have you here today. We are recording this webinar for future use and for playback. Today is April the 23rd, 2014. And as all of you know, we have these webinars on a quarterly basis to assist those individuals who are a little bit more advanced in the area of planned giving, to give them greater education in the area of different types of planned gifts. My name is Jim Murphy, and I'm the Managing Program Director at the Episcopal Church Foundation. I think many of you already know the Episcopal Church Foundation. You know that we are a lay-led and independent organization that serves the leadership needs throughout the Episcopal Church. We do that in two primary ways: through our leadership resources that we provide, through materials as well as our website, as well as financial resources, and able to assist congregations, dioceses, and related Episcopal entities in the area of capital campaigns, planned giving, endowment management, and various other activities. So I'd like to invite everyone to do is, if you do have a question, you may ask your question at any time of the webinar today. And the way you would do that is by typing in your question to the chat line that's on the screen. And I will, in the background, make sure that we can ask those questions to David and to Nancy. Without further ado, I'd also like to introduce Meg King, for those of you who don't know Meg. Meg is our Assistant Program Director in charge of planned giving, and she is the person that many of you would contact if you have need of a life income gift illustration or any of our various and sundry planned giving materials. So Meg is always happy to help.
Hi everyone, I'm happy to be here and look forward to the rest of the webinar.
Okay, so without further ado, I wanted to introduce our two speakers for today, David Leibel and Nancy Marks. David is someone that many of you will already know. David has been a great friend of the Episcopal Church Foundation for many, many years. He was our attorney formerly before he took on his new staff role at UBS Securities. David is functioning here as a volunteer and advisor to the Episcopal Church Foundation, and specifically to financial resources. And I'm very happy, David, that you can join us here. David is a graduate of Trinity College in Connecticut, has his law degree from Fordham, and an LLM in taxation from New York University. So it's wonderful for you to be here with us today, David.
Thank you, Jim.
And the other person I'd like to introduce is someone who unfortunately could not be in a location where she had video access, and that is our new attorney at Cummings and Lockwood, Nancy Marks. And this is really an introduction of Nancy to our various development professionals. Nancy has been already instrumental in helping Meg and I in a number of trust issues. And Nancy will continue in that role, and we're very happy that she could actually join us to give us some insights in the area of trusts and planned giving. Just briefly, Nancy's biography. Nancy's practiced in the area of estate planning and administration of estates and trusts since 1985, and has focused in the area of tax-exempt charitable organizations and charitable giving since 1993. She advises a number of charities and public foundations. You are a graduate of Prince Villa College and the Los Angeles Arts Center College for Design, having then getting your law degree from the University of Texas. Is it Go Horns? I can't remember. I can never remember what.
I'm a terrible Texan with no football knowledge.
Well, I'm a terrible Michigander with no football knowledge. That's why I live in New York. So without further ado, David, I'm going to turn the control of the slides over to you. So if you'd like to go to the next slide, and feel free to give any additional introduction before you get started.
Thank you, Jim. And it's great to be here with Nancy and with Jim and Meg. I worked with the Episcopal Church Foundation from 1996 to September 30th, 2007. It was always a pleasure. It's a great organization. I am a member of the Episcopal Church as well, and my parish is Christ Church in Easton, Connecticut. I crossed over to the financial services industry, but you couldn't be in better hands with Nancy Marks, who basically taught me virtually everything I know about charitable planning, and is one of the finest lawyers and finest people I know. So why don't we jump in? Today's topic is charitable remainder trusts. And for those of you who have been in and around the plan giving world over the last between 5 and 7 years, you may say, well, I haven't seen a lot of those. Well, there have been some reasons for that. The economic downturn and the reduction in the stock market, significant reduction, as well as the real estate market, has led to fewer people doing these types of planned gifts. But I believe that's going to change, and I believe you're going to start seeing, I think there is some anecdotal evidence that you're going to start seeing an increase in the number of charitable remainder trusts that are established. So we all want to be positioned properly, and obviously working through the Episcopal Church Foundation enables you to do that in order to take advantage of some of the opportunities that I believe will be coming down the pike with respect to charitable remainder trusts. Why do I think that charitable remainder trusts are going to increase in number? Well, let me give you a little bit of a background in terms of how many there are in existence. As of 2009, there were approximately 114,000 charitable remainder trusts in existence, of which were 96,000 were charitable remainder unit trusts, which we'll discuss, and 18,000 were charitable remainder annuity trusts, which we'll also briefly discuss, although really there isn't much reason to set up an annuity trust anymore now that charitable gift annuities have become so popular. So that's the number that are out there, so it's not a small number, but over the last 5 or 6 years the number hasn't been increasing dramatically. And why do I think that'll change? Let's start with the increase in the income tax rates. For years we had a 15% capital gains rate. 15% had come down from 28% in the 90s to 20% and then 15%. As there was a reduction in, each time there was a reduction in the capital gains rate, we saw a reduction in the number of charitable remainder trusts. The reason for that is if people think they're going to face a 20-something% haircut when they sell out of a concentrated position, they may want to consider some of the alternatives which would either, delay that haircut or even eliminate that haircut. One of the most common of which is the charitable remainder trust. But now we're in an environment where for people with high incomes, the basic long-term capital gains rate is 20%. And in addition, to pay for the new Health Care Act, there is a 3.8% tax on net investment income. So you're up at approximately 24%, exactly 23.8%. This makes charitable remainder trusts look a lot more attractive because you're losing a quarter of the proceeds, in terms of the appreciated proceeds in taxation. If, on the other hand, you transfer them to charitable remainder trust, you can reinvest the entire amount in a tax-deferred fashion. You will have the payments as they come out be taxed, but you'll, instead of getting 5 or 6% of 75% of the assets, which you'd get with if you paid the capital gains tax, you're getting 5 or 6% of 100% of the assets because you haven't been subject to the capital gains tax. Another reason I'm optimistic about remainder trusts is that they're typically funded with two kinds of assets. One is appreciated securities, typically a concentrated position in a single security, but not always. Well, the market was not in the best of shape going back several years, but we're now beyond the highs of 2007. Companies are reporting good earnings, and it looks like there is some stability in the stock market. So that's a good thing, because you always want to give your assets away to a charitable entity when they're priced quite high. So if you have somebody with a high-priced security that has a very low-cost basis, then the Charitable Remainder Trust becomes an effective diversification vehicle. Another thing is that baby boomers, of which I am one, although I'm towards the tail end, are entering every day rapidly retirement. And as we all know, the day and age of what my father and many of our parents had, which was a fixed pension plan from work, really doesn't exist anymore. And so you have your 401ks and your IRAs, but when you add them all up, and people say you shouldn't be spending more than 4% of your net assets each year, so 4% of whatever that number is that you've saved for retirement, well, you may find that you don't have enough to maintain your lifestyle. Well, with the Charitable Remainder Trust, you can increase your yield on dividends or fixed income to a fixed percentage of 5 or 6%, sometimes even as high as 7%. And that can act as a great way to supplement retirement for baby boomers. Finally, historically, people would consider making large bequests at death. One of the reasons they did this, a major driver for that, was that any amounts going to charity at death would not be subject to federal estate tax. So they would reduce the size of your taxable estate, and as such, it was very common to see larger clients leave a big portion of their estate to charity. The problem is now the estate tax exemption at the federal level is $5,340,000 indexed for inflation, so it's $10,680,000 for a couple. Used to be that it was $600,000 per person. Well, for many of our donors, they wouldn't get a deduction if they left the assets at death because their estates wouldn't be subject to a federal estate tax. So why not consider accelerating that deduction in exchange for a life income stream in the form of an annuity or a charitable remainder trust? That way you're going to get the income tax breaks, you get the higher income yield, and you're also taking the asset out of your estate if it's a taxable estate. So those are some of my reasons. And now let's jump in and dust off the rules for charitable remainder trusts that were so popular in the 90s and going into the early 2000s, and because I believe that we're going to see a resurgence. Before we get into the rules on how charitable remainder trusts work, I think it's important to step back. I understand there's probably varying skill sets in the audience, and it's important to understand the basics and the foundations of how the charitable deductibility rules work and what are the more efficient ways to make gifts before we jump into how charitable remainder trusts work. So since the 19-teens, when we had the income, gift, and estate tax come into the system for the first time, we have now got a situation where charitable giving, once these taxes came in the 19-teens to pay for World War I, charitable giving was given some kind of preferable treatment for both income tax, gift, and estate tax purposes. And certain types of giving were more favorable than others. So you'll notice under the tax code that a lifetime gift is more valuable than a gift at death, which is also called a testamentary gift. Why is that? Well, with a lifetime gift, you get the income tax charitable deduction. We'll talk about how the fact that you can avoid the built-in capital gain, and you also take the asset out of your estate. Testamentary gift, you're just taking it out of your estate, but if you don't have a taxable estate, you haven't accomplished that much. Gifts to public charities, like the Episcopal Church or your church or organization, are treated more favorably from deductibility purposes than gifts to private foundations, typically controlled by families or corporations. and then appreciated property gifts. So those gifts with built-in capital gains. So I have $1 million of GE stock. I paid $100,000 for it. If I were to sell it, I'd have gain on $900,000. But if I gave it to a public charity, that gain would disappear. And in addition, I'd get a fair market value deduction for the $1 million contribution. So when choosing among assets to give to charity, appreciated stock or appreciated property is typically more attractive is certainly more attractive than a gift of cash. In order to qualify for the income tax charitable deduction, the transfer has to be in a certain form. Basically, they're trying to avoid situations where you make a gift to a school and take a charitable deduction, but really you're paying tuition. So there can't be any kind of quid pro quo. If there is, that reduces the amount of the deduction or perhaps limits it. So the transfer has to be made to a qualified charity, has to be a contribution, as I mentioned, not a payment for goods or services, has to be made in cash or other qualified property, and as we'll see, it can't exceed a specific percentage of an individual's, the donor's adjusted gross income. Now, very importantly, in order to get a charitable deduction, you have to itemize. Otherwise, if you use the standard deduction, basically the charitable deduction is deemed to be built into that. So the donor has to itemize in order to qualify. Remember I talked about the two different types of charities, public charities and private foundations? Public charities being the more favorably treated under the tax law. Well, what is a public charity? Well, typically it's what you think of it. It's churches, educational institutions, hospitals, but in addition there are other kinds of public charities that are publicly supported or they have a particular status that qualifies them. That includes things like community foundations, donor-advised funds, organizations where a sufficient amount of the support comes from the general public that they're deemed to be public charities. Private foundations, I mentioned, are typically set up by families, individual families, or they're set up by an individual corporation, and they're treated less favorably under the law. One of the ways public charities are treated more favorably is if you make a gift of cash to a public charity, you're entitled to deduct that up to 50% of your adjusted gross income in the year of the gift. If, on the other hand, you give a gift of long-term appreciated stock, long-term capital gain property to a public charity, you're only allowed to deduct that up to 30% of your adjusted gross income. Well, if you want to get to the full 50%, many times the best way to do that is to give long-term capital gain up to 30% of your adjusted gross income, and to get to the 50, give the other 20% in cash. Private foundation donees, if you make a gift to your private foundation, you're only entitled to deduct that up to 30% of your adjusted gross income for cash gifts, and up to 20% for long-term capital gains gifts. Now, what if you make a large gift in a year, and it far exceeds your adjusted gross income? Well, you have 5 years, additional years, to take the deduction. It carries forward for 5 years, the unused deduction, subject to the same percentage limitations. So you have a total of 6 years to take the charitable deduction for income tax purposes. Another way that public charities are treated more favorably is that typically a gift to a public charity entitles the donor to a full fair market value deduction. So if the property is worth $1 million, even though I paid $100,000 for it, if I give it to my Episcopal church or organization, I'm entitled to $1 million deduction, subject to obviously the adjusted gross income limitation. So that's the general rule for public charities. Now, if you have tangible personal property, so you have a collectible item, say it's a piece of artwork that you bought and it's appreciated significantly over the years and you want to give it to charity. The general rule is that if I make a gift of tangible personal property that's appreciated in value to a charitable organization, my deduction is limited to the lesser of the fair market value or my cost basis, basically what I paid for it, unless the gift of the tangible personal property is for a related use. What's a related use? Okay. If you give a painting to the Episcopal Church Foundation, that's probably not related to its exempt purposes. If you give the same painting to the Metropolitan Museum of Art, that is related. As such, the gift to the Episcopal Church Foundation is limited to a cost basis deduction. The gift to the museum entitles the donor to a full fair market value deduction. So always be aware for tangible personal property that that's the difference. Now you may be scratching your head and saying, look, I know that I have given lots of gifts to my church, for a church bazaar, that where I've taken a deduction for the fair market value of that gift. Yes, but if you let's say you give something like a car that's 5 years old to your church, you're not taking a deduction for what you paid for it, the fair market value then. You're taking a deduction for the fair market now, which is less than what you paid for it. So your cost basis is the $25,000 you paid for the car 5 years ago. Your deduction is for the $12,000 that the car is worth now, so you're getting a deduction for the lesser of. The asset has depreciated in value instead of appreciating. What about private foundation donees? General rule is that gifts to private foundations are limited, the deduction, to the donor's cost basis. There are some exceptions to that, including gifts of publicly traded securities, which if you give them to a foundation, you're typically allowed a full fair market value deduction. This is a handy-dandy chart. I'm not going to go into it, but it kind of sums up some of the things that I've already said. Now let's kind of dive in to today's topic. In the old days, before 1969 was a watershed year in terms of the tax laws and charitable giving. Most of the rules that we're discussing today, most of the rules that you hear about in terms of charitable giving came in the sweeping legislation in 1969 that put into place the rules for charitable remainder trusts, charitable lead trusts, private foundations, among other types of entities and rules regarding charitable giving. The reason that we had all these rules were that people were taking advantage of the charitable deduction rules, kind of giving stuff to charity, retaining an income interest, but really taking a big charitable deduction, but the charity wasn't getting much of anything. As such, all these rules came in to kind of discourage or prohibit that type of behavior. So it's important to understand that if you retain some kind of an interest in a gift, it has to be in a specific format that is permitted by the tax code. Otherwise, you don't get any charitable deduction. In fact, you may have made a taxable gift, even though you're making it to a charity. You may actually have to pay tax rather than get a deduction. So it's very important to remember that. Well, typically outright gifts of any asset to a charity are typically deductible. And this includes if you give an undivided fractional or percentage gift to a charitable organization. So I give 1/2 of a piece of investment real estate that I own. That's a percentage or a fraction. If I say, look, I'm going to give the charity for 10 years the income stream from that investment real estate, but I'm going to keep the underlying property, that is a retained interest that is not in a permissible format according to the tax code. And I would not get a deduction. In fact, I would be making a taxable gift of the income stream to the charity. So what are the types of, they're called partial interest gifts for tax purposes, but they're gifts where the donor has retained an interest for themselves or for somebody else. they have to be in a specific form. Well, obviously we're going to get to charitable remainder trust because that's today's topics, but what are some of the other forms? One of them is that I can take my personal residence or a farm, and I can contribute a remainder interest in that personal residence or farm to a charitable organization, get a deduction for the value of the remainder interest, but keep a life estate to live there for my remaining lifetime. Now, if you have a donor who is going to give you their personal residence at their death or their entire estate, why not consider using a remainder interest in this personal residence? Basically, they keep a life estate. You guarantee that you're going to get the property because that you've got a contractual arrangement. They're going to get an income tax deduction now to offset their income. So that can be a very effective vehicle for the right kind of donor. I'm going to pass over conservation easements and pooled income trust funds. Charitable lead trusts are a form of permitted retained interest gift or partial interest gift or split interest gift. They're typically done by very wealthy donors who give a stream of income over a period of years to a charitable organization with the remainder going to a family member. Usually you see these set up minimum $5 million and up. Even though there are 114,000 charitable remainder trusts in existence, there are only 6,600 charitable lead trusts in existence. Obviously, charitable remainder trusts are permissible. In addition, although it's not statutory, charitable gift annuities, which I'm sure you're all familiar with, are permitted split interest, partial interest gifts. What is a charitable remainder trust? And if this is basic for some, I apologize, but it's important for others to kind of get the foundation, because in addition to the charitable gift annuity, the charitable remainder trust those are the core alternatives for a planned giving program. That's basically what you're going to be looking at. Some people want to do the charitable gift annuity. Some people will want to do the charitable remainder unit trust. So it's important to understand obviously you understand how the annuities work. It's important to understand how the charitable remainder trust work. It's an irrevocable trust. I set it up. I fund it with a low basis asset that is appreciated significantly in value. So in my case, it was the $1 million GE stock that I paid $100,000 for. As we'll see later, when the trustee later sells that, there won't be any capital gains tax paid because a charitable remainder trust is a tax-exempt entity. Think of it like a charitable IRA. And just like an IRA, the payments will be taxable. They'll just be taxable in a little bit more favorable treatment than an IRA, which is always at ordinary income rates, whereas the charitable remainder trust, many times the payments will come out to you as long-term capital gains or qualified dividends. But the entity itself is not taxable, so it allows you to diversify out of a low basis position. The donor retains, or someone else retains, an income stream for a period of years. As we'll see, that can be the donor's lifetime, the donor and the donor's spouse's lifetime, or a fixed term of years, which cannot exceed 20 years. You can even combine a life plus a fixed term if you want to have a fixed term for your children. Just realize that you may be using some of your gift tax exemption for that. Gets a little dicey if you want to add grandchildren because that gets into the generation skipping rules, so best to kind of avoid that. At the end of whatever term, the assets in the trust, whatever's left, pass to one or more designated charities. Now it's important to note here that if you have a donor and they want to set up a charitable remainder trust, if you work through the foundation, obviously the foundation, defrays the cost of the legal fees to set that up. But more importantly, the quid pro quo for setting the charitable remainder trust up through the foundation is that the remainder beneficiary, whoever you name, one or more beneficiaries, can't be changed, or at least the Episcopal organizations can't be changed. Now, if the donor goes to their own council and sets this up, they'll be told that they have the right to change the charitable remainder organizations at any time. They can put that provision in there. Well, in my practice, I saw many times when people retire and they move to Florida or something, all of a sudden, lifelong attachment to their church or local Episcopal organization ceases. And they call me up and say, hey, I want to change to this other organization down here in Florida or wherever they've gone. North Carolina, usually it's a state that's warmer and without an estate tax, which North Carolina, by the way, got rid of in January of 2013. Not that that's relevant. All right, so you can set up a charitable remainder trust for the donor's lifetime, as I mentioned, or for a term of years not to exceed 20. It can be for either single beneficiary, typically the donor, or many times it's the donor and the donor's spouse who are the beneficiaries, and it's paid for their joint lifetimes. There are two types of charitable remainder trusts. One, most relevant today, is the charitable remainder unit trust. The other is the charitable remainder annuity trust. And importantly to note, you can set up any kind of charitable remainder trust during the donor's lifetime or at the donor's death for the benefit of somebody else. So during the lifetime, it is called an inter vivos charitable remainder trust. At the donor's death, it is a testamentary charitable remainder trust. What are the differences between a charitable remainder annuity trust and a charitable remainder unit trust? With the annuity trust, I put my $1 million of GE stock into a trust where I'm the beneficiary for my lifetime. I choose a 5% payout. That's the minimum payout you can choose. The maximum is going to be determined by some of the deductibility rules we'll touch on in a minute. I'm entitled to 5% of the amount contributed each year for the remainder of my lifetime. That means I'm entitled to $50,000, 5% of $1 million, in year 1, year 5, year 10. It doesn't matter what happens to the value of the trust. If they go up in value, I don't share in the appreciation. If the trust assets go down in value over the years, I don't share in the depreciation unless the trust actually loses all of its assets. The second and more common type of charitable remainder trust, I think I said there's about 84% of those out there, charitable remainder trusts out there, is a charitable remainder unit trust. How does that work? Put the same $1 million of GE stock into charitable remainder unit trust, and in year 1, choose a 5% payout. I'm the beneficiary as well as the donor. Year 1, I get a $50,000 payment, 5% of the $1 million. In year 5, the trust has done well, and the $1 million, even though I've taken the 5% out, has grown to $2 million. Well, in year 5, under a unit trust, I'm entitled to 5% of whatever the value of the assets are, revalued as of January 1 of each year. So for January 1 of 2015, whatever the value is, I get 5% of that for the remainder of 2015, either an annual payment, semi-annual, or quarterly, sometimes for large trusts, monthly. So if it's grown from $1 million to $2 million, I'm getting 5% of $2 million, or $100,000 of income. If it goes down in value from $1 million to $500,000, I'm only getting 5% of $500,000, or $25,000. So the payment will vary depending on how the trust assets do over time. They'll be fixed each year, but they will vary from year to year. As such, somebody setting up a charitable remainder unit trust really needs to be able to withstand some ups and downs. The flip side of that is with the charitable remainder unit trust, you hopefully will maintain purchasing power over time, meaning that you will keep pace if you don't choose too high a payout percentage with inflation, so your 5% going out 10 years will still be worth 5% and not be reduced by the amount of inflation that it would be in an annuity trust where you only get 5% of the initial contribution. As I mentioned, if you think about a charitable remainder trust as kind of a charitable IRA, it kind of makes it easier to kind of think about how it works. So the trust itself is tax exempt. As such, so it doesn't pay any income tax itself. As such, it is a great vehicle for diversifying out of a low basis asset that you would pay a large capital gain on if you sold outside of the trust. In addition to the diversification benefits, the donor, the grantor, same thing, is entitled to an income gift or income tax deduction, depending on lifetime or testamentary, for not the full amount, so not the full $1 million, but the $1 million reduced by the present value of my life income interest. So if I set it up for my lifetime, I've retained an interest in that charitable remainder trust, $1 million. That is significant, 5% of $1 million. At my age, 52, it may be that represents the present value of my life income interest represents about 60-70% or 700,000. Well, that 700,000 is not deductible because I've retained that interest. What is deductible is the present value of the charity's future remainder interest at my death. So if my life income interest is 70% or 700,000, then the charitable remainder interest is 30% or 300,000. And obviously, Meg and the foundation will run those calculations for you. But it's important to know you do get a deduction, but it's not for the full fair market value of what you put into the charitable remainder trust. It has to be reduced by the present value of your life income interest. In addition, in order to have a qualified charitable remainder trust, the value of the charitable deduction has to be at least 10% of the amount contributed. So if I set up, again, this is done through a computer program that Meg can help you with. If I set up my charitable remainder trust with $1 million, the present value of the charity's future remainder interest, which is the charitable deduction, has to be at least $100,000 when I set it up. 10% of the amount contributed. Otherwise, I don't have a qualified charitable remainder trust, and I don't get any of the tax breaks. Another reason that people like the charitable remainder trust is in a time of low kind of yields. Some bonds are yielding less than 2%, and even stock dividends are at relatively historic lows. 2% maybe at max. You can get that 5 or 6 or sometimes even 7% yield, so that can help supplement your income, particularly in retirement. As we'll see, there are different types of charitable remainder unit trusts out there, and we'll touch briefly on one you can use for illiquid assets. That's called a flip CRUT. But most of them are set up so you receive the fixed percentage, in my case the 5%, starting immediately, and there is no deferral of the payment. This is, if you have time and you want to go through this, many times when people are working with their advisors, they're considering the alternatives if they've got this concentrated position. Maybe they're a corporate executive getting towards retirement, and they want to figure out how to diversify. Obviously, they can sell and reinvest. They can consider something like a charitable remainder trust, or there are even financial derivative type products like collars and writing covered calls, prepaid variable forward contracts. Gets to be pretty complicated, but for the very large positions, you always kind of look at all of the different alternatives. Sometimes you do one of each. I've kind of given this example, except I've done it with me. But if you're looking at quickly looking at how somebody might consider a charitable mandatory trust. You've got a couple, 65 and the 35% income tax bracket. The grantor owns $1 million of GE stock with a tax basis of $100,000, so there's a $900,000 built-in gain. It doesn't produce, well, GE does produce dividends, but assuming it's a stock that doesn't produce any dividends, donors getting towards retirement, wants to diversify, to reduce the risk associated with that stock. Remember Enron, Lehman Brothers, AIG. A single stock position is a great way to get rich. It's a great way to lose all of your money. And the donor wants a little more cash flow. Selling and reinvesting, I had to redo these numbers. They were under the old rules. You'll see how it wasn't very attractive to not sell and reinvest when the capital gains rate was 15%, because all you did was at the federal level pay a 15% capital gain on the $900,000, which was only $135,000. That's not terrible. Well, now if we're at the 23.8%, we have someone with a high income, that capital gains tax is no longer $135,000, but it is $214,200. So instead of the net proceeds being $865,000, they're $785,800. And the income on that number has been reduced from $51,900 to $47,148. So we have a situation where these tax rates now are really eating into, how the kind of income we can get if we sell and reinvest. There is this new tax, in addition to the capital gains rate going from 15 to 20% for high-income individuals. There's also this new 3.8% tax on investment income in order to pay for the new Health Care Act. Nancy, do you want to comment on that?
I was just going to say that, a lot of people were sort of shocked to find out that it applied to them last year, that, particularly if you're getting towards retirement and you may not have a particularly large adjusted gross income normally, but you go to sell a substantial position, you may find suddenly that now you are subject to that tax. And so it creates an even greater incentive than in prior years to try to avoid the capital gains tax by funding a charitable remainder trust.
I agree. So let's look at this slide. This is also under the old rules. You'll see now that the increase in the income with the CRUT based on the higher tax rate is no longer $10,200, but instead $14,382. Wanted to show you kind of how the old tax rules would work and how it would be the new tax rules work. Never underestimate the motivator that higher tax rates is for charitable giving. If you ever want to look at a study of when the largest amount of private foundations were established by wealthy families, it's when the income tax rates were at their absolute highest. World War II, pay for the war, those income tax rates drop and you'll see fewer foundations. I'm not saying you don't need charitable motivation. I'm saying that charitable motivation with the kick in the pants from a higher tax rate leads to increased philanthropy. I think we've talked about most of these benefits. I mean, the negatives are things like not getting the economic benefits associated with a charitable remainder trust. So that economic benefits achieved slide should be economic benefits not achieved. And it really means that somebody dies shorter than their life expectancy, so they don't get all of the income that they thought they were going to get from the charitable remainder trust. But the most important point here is that at the end of the trust term, when mom and dad are gone, all the assets go to the charity that's named in the instrument. And that leaves the children out of luck. So people have to think about that who are thinking about charitable remainder trust. Sometimes people buy a life insurance policy with some of the increased income that's owned by an irrevocable life insurance trust to kind of replace the asset that went to charity. It's called a wealth replacement trust.
And
many
David,
times, yeah.
With the estate tax not being such a consideration these days, it may be possible to just buy the policy and own it and not really have to.
Right. You don't even have to use the trust now if you're a couple and it's under $10,680,000. You basically can just have it in your own name. So thank you, Nancy. That was a great point. I'm not going to go into the net income with makeup trust. That's for younger, very wealthy individuals who perhaps have sold out of a business and want to have kind of a rainy day retirement fund that they're going to defer for 20, 25 years. But I will touch on the flip credit. So I put appreciated securities, publicly traded securities, into a charitable remainder trust. I say I want to get a 5% payout on my $1 million going in, and I want to receive it quarterly. So 3 months from the time I set it up, the first payment, 1 quarter of the year's payment. Well, that's fine because I can sell that publicly traded security, which isn't generating any yield, tomorrow to make the payment. What if I funded that trust with investment real estate that is just raw land, doesn't generate any income? How do I make the payment if it hasn't sold? Well, I don't necessarily have to make it within that quarter, but I have to make it. So for 2014, I have to make that payment by the due date for the tax return for the trust the next year. So April 15th of 2015, or maybe if you can get some, an extension, you could take it out a little bit further. If it doesn't sell, and I don't make the distribution, I disqualify the trust for tax benefits. Well, what do? I haven't sold the real estate. I don't have any income. Well, all of a sudden, the trustee is going to write out a little deed and deed you back 5% interest, whatever the payment was, in the form of an undivided interest in the real estate you were trying to get rid of. Not a great result. But it's even worse than that. It's deemed as if you received cash for tax purposes. So you're taxed on property, income you never even got. How do you avoid that? Well, there is a form of charitable remainder trust known as a flip credit. It starts out as a net income trust, and then upon the occurrence of a triggering event, the sale of the raw land, as of January 1 of the next year, it becomes the standard credit where I get my payments every quarter. Well, it's got cash in it to make those payments at that point. Prior to the sale, it's only what's called a net income trust. So I only get income if there is income. So this has become a very helpful vehicle for particularly being, charitable remainder trust funded with real estate, closely held business interests, assuming you can get around any tax problems or tax traps that are associated with those. So the flip credit came in 1997, I believe, and has been, for at least for a while during the real estate boom, it was probably about 60% of the charitable remainder trusts I was setting up. You have a lot of flexibility as to what you can do. You don't have to use this for liquid assets. You can use it as, to trigger retirement. When I get to age 65, all of a sudden I get the payments and whatever it's grown to, and maybe even get some of the IOU account that you'd get if it was a makeup trust. I don't want to go any further than that except to say if you got an illiquid asset, then you're looking at the flip credit. So when do you consider the flip credit? Real estate, closely held business interest, tangible personal property, and by the way, if you fund a charitable remainder trust, a flip credit with tangible personal property, you don't get a deduction when you fund it. Here's another weird rule on tangible personal property. You get a deduction when in the year the tangible personal property is sold by the trust. So if you fund it in 2014 with your Stradivarius, and there actually was a ruling on this, but you don't sell that Stradivarius till 2015, there's no income tax deduction on the child remainder interest until 2015. Couple of caveats that you want to consider. When you're funding a charitable remainder trust with publicly traded securities, you don't really have to worry about a lot of stuff. It all kind of falls into place. You can use the standard charitable unit trust. You don't have to, or into unit trust, you don't have to use a flip cut. But transfers of privately held assets are, there's no public market for them. So they have a bunch of concerns that can mess up how a child remainder trust works and actually cause significant problems. The first is, let's say I have a piece of real estate, investment real estate, and I contributed to my charitable remainder trust. But before I did that, I had actually signed a piece of paper saying that I agreed to sell it down the road, but I hadn't gone to closing. If the donor is obligated to sell the property prior to funding the child remainder trust, guess what? The donor is personally responsible for the capital gain. In my case, it was the $900,000 capital gain, $14,000, $200. But you know what? I can't reach into the child remainder trust, the $1 million that proceeds, to pay the tax. I got to pay it out of my own pocket. So there can't be any prearranged sale. You got to be very careful. The donor has to be able to pull the plug on any sale before funding the trust. And it's not the buyer's potential ability to pull out. It's the seller, the donor. There's all sorts of issues with what's called unrelated business income tax, and those are things that have been on the books since 1950, where charities engaging in certain types of business or whether the property is debt financed can wreak havoc with charitable remainder trusts. There's also issues if you fund the trust with closely held business interests and you continue to own an interest in that company. You have to look at every transaction to see if you violated these self-dealing rules. And here's the most important point in addition to prearranged sale, and that is if you have real estate, if it's got a mortgage on it, just forget about doing a child remainder trust. It doesn't work. It not only causes unrelated business income tax problems inside the trust, but it also causes the donor to recognize income to the extent of the mortgage because it's considered to be forgiveness of indebtedness income. Remember, all these people who got their kind of mortgages reduced and waived by the financial institutions, they had forgiveness of indebtedness income with the IRS. So if you have mortgage property and you contributed to a charitable entity, you're deemed to have had that mortgage taken off your hands, and that has deemed recognition of income. Last thing I want to say is the child remainder trusts are subject to a series of taxation. Even though the trust is tax exempt, the payments are not. Very important to understand. The payments, what happens is all the different kinds of income, ordinary income, capital gains, tax exempt income, and your return, if you have any principal or basis, they all go into this kind of accounting system called the four-tier system. And as the payments come out, they kind of come out in it's called the worst in, first out kind of taxation. Although it's gotten a little bit more complicated since we now have the qualified dividends being at 15 or 20% depending on your income. It's deemed to, the payments will be taxable, and they will be taxable in some form of ordinary income or long-term capital gain, depending on how the trust assets are invested. So if you're invested primarily in long-term capital gains, so stocks that just generate a dividend, you're going to get maybe 15 or 20% will be your primary tax rate. If on the other hand you're invested in bonds and it all comes out at ordinary income rates, you could be as high as 39.6%. But the important to note that the payments, although the trust is tax exempt, the payments as they come out are taxable to the donor, and they are taxable under this weird system of taxation called the four-tier system that's unique to charitable remainder trusts. I wanted to kind of turn it over to Jim to walk you through how the foundation can kind of help you at every step of the way in with prospects in terms of how thinking about what's the proper planned gift and also executing on the documentation on that. Jim?
Thank you very much, David. And also, just so that everyone knows who's out there, if you do have a question for David or Nancy, please just type it into the chat message. And we still have a few more minutes where we can answer those questions, so please feel free to do that. So the Episcopal Church Foundation, as many of you know, is the main resource for planned giving throughout the Episcopal Church, and we focus in on educating leaders such as yourselves to be more capable of talking about the different types of planned gifts and encouraging people in their generosity when making this very unique type of gift. Something that we are very proud to be doing and have been doing for almost 20 years now has been working with individual donors and their representatives in putting together charitable remainder trusts and then serving as trustee for those trusts so that all of the back office work, the tax documentation and everything is taken care of, as well as having the monies invested in a professional investment advisor. So what many of you may be aware of, and that Nancy Marks, as our new attorney, is deeply involved in, is that if you happen to have someone out there that may fit the profile of the type of donor that David's been describing, they may have an asset that is highly appreciated, that they would like to shield from some of those taxes, that they could create a charitable remainder trust and transfer the assets into that trust. Well, the wonderful thing to know is that the Episcopal Church Foundation, for free, can work with you and your donor to create the initial trust documents for the donor to review with their attorney. After those documents have been reviewed, and if they're acceptable, your donor can then finalize the trust and allow ECF to then serve as trustee over that trust for the rest of your lives. And as I said before, ECF can then take care of all of the back office work in setting up the trust, getting the IRS ID number, and all of the various administrative functions that go along with being trustee. We work with State Street Bank in Boston to invest the assets, and there, if you don't know of them, they're one of the largest, if not the largest, manager of charitable assets throughout the world. We then, obviously, when the trust would come to its maturity, when those who are receiving income would pass away, the Episcopal Church Foundation would take the initiative to liquidate those assets and make those distributions to the various Episcopal entities that exist and that have been named. And as I think David had mentioned, something that's unique about charitable remainder trusts, as far as the Episcopal Church Foundation can handle them, is that as long as 51%, the majority of the ultimate value of the trust, will be left to Episcopal entities, 49% or less can go to non-Episcopal entities. And this can be very advantageous for those individuals who have a great passion for things other than the Episcopal Church. And it's something that we can directly assist in creating.
Yeah, that's a great point, Jim. But also, I mean, you should talk about how you don't knock out the charity that brought you the opportunity, because the Episcopal charity who you're setting it up for initially, typically that interest is always kind of irrevocable and protected, can't be changed.
That is true. That is the norm when we set up a trust, that the entities that have been designated are irrevocable. They are not changed. And so that can be
the Episcopal entity.
Well, it can be all the entities if that's what the donor wishes, Um, and so that can be an advantage to those who are considering making one. The big advantage is, of course, that we can work with Nancy Marks in putting together the documents for the donor and the donor's attorney to review free of charge up front, and that enables the entire process to move forward. And since we have a fairly low threshold, $100,000 to create a trust, there are many, many people in your congregations or constituents to your organization that can benefit from a charitable remainder trust, and its flexibility is quite substantial, where you can have multiple individuals who will receive income for their life, and so it's just a very advantageous gift. And what I'd like to do is give Nancy Marks the floor for just one more minute before we wrap up.
Thank you, Jim. Um, I guess that, coming to the end of this and having listened to everything that David said, I think it's just helpful to take a step back up from the whole process and say, where is the charitable remainder trust in my planning for my donors? And obviously having that outright gift, that's money that's usable immediately, is wonderful. It's a lot of times, though, the donor feels that they can't part with the funds now, and that's where your planned giving program comes in, and that's where the donor looks then, is a charitable gift annuity the right way to go, or do I have enough funds that I'd like to have my own dedicated trust? And then you're looking at a charitable remainder unitrust. And that's really where you can create a partnership with the donor and build the relationship with them and kind of stay on their radar screen. And so I think that it's really important to think of this whole thing as a toolbox for how you can add value to your donors and allow them to participate in your mission.
Very well said, Nancy. Thank you. And without a doubt, I mean, this is one of many different planned gifts. It may not be appropriate for everyone. However, it is a tool in your toolbox that's important to know about, because if you're not raising awareness that you have this capacity to help people in this way, others are raising it. And you can truly, as I say many times, as I say to Richard Hoff, who's on the line with us today, I say that you can make your charity be the hero. You can be the hero to your donor by giving them options to make gifts to you in new and different ways. Just to wrap up today, I just wanted to make sure that everyone is aware, and I think you should be, that you can listen to all of our webinars that we do. They are all recorded on our ecfvp.org site. In addition, there's one that I will draw your attention to in particular, and that is the one in the middle of the screen right now, Prospective Donors. We have a 35-minute webinar that I recorded that goes over all the basics of the different types of planned gifts. And you can share that with your donor, and as long as they have an internet connection, they can learn all the basics that they need to know about the different types of planned gifts and how they can support your organization and its mission. There are some wonderful webinars coming up, which you can see on the screen, and following this webinar, you will receive not only a recording of it, but also some other documentation, one from Cummings and Lockwood and another that I should be able to send you from the Plan Giving Design Center. Because charitable remainder trusts are coming back in popularity, as David has intimated, and given their flexibility, they fit with many of the changing circumstances that people are dealing with in this day and age. Just to wrap up, the Episcopal Church Foundation is here to serve you as leaders of your institution. It is also here to serve the donors of your institutions in these unique gifts of charitable remainder trusts, charitable gift annuities, pooled income funds, and in those very, very rare cases for your wealthiest donors, in the case of a charitable lead trust. We're here to assist you and provide the medium for you to engage with your donors in these gifts. And you can certainly contact Meg King at any time and receive whatever illustrations you might require to show your donors for what will work for them. So, oh, and I see a note about David and Nancy's contact information. I will be sending out the slideshow Unfortunately, due to the nature of the legal relationship, you would need to come to us here at the Episcopal Church Foundation. You can't have direct contact with Nancy unless you, of course, directly are seeking to engage her legally, which you can certainly do. I'm sure Cummings and Lockwood would appreciate that. But for all of the different life income gifts, you would need to work with ECF instead of directly with Nancy. But to that end, David Leibel and Nancy Martz, I just want to thank you for a wonderful webinar, a webinar that will help hundreds of Episcopal entities all across the country. Thank you for your time, your wisdom, and your insight, and your ongoing support of the Episcopal Church Foundation. So
Thank you,
very
Jim.
much.
My pleasure.
Thank you, Jim.
And thank you all for joining us today. We look forward to having you join us in another future webinar. Please feel free to contact any of us at the Episcopal Church Foundation. Always happy to help. So have a great day. Thank you.